Eventually, every long-lived asset leaves the company. We sell it, retire it, sometimes we trade it in. In this lesson, we're going to account for that moment. We call it disposal or disposition. We'll also answer a question that confuses a lot of students. Why does selling an asset almost always create a gain or a loss? And why is a gain not necessarily good news? Remember the concept of cost allocation. Depreciation allocates cost, it does not track market value. That one fact is the entire reason that dispositions create gains and losses to begin with. Because book value, cost minus accumulated depreciation, is almost never equal to what the asset is actually worth when we sell it. So when the cash we receive differs from the book value we're carrying, the difference has to go somewhere. We call it a gain or a loss. Accounting for a disposal is always 2 steps. And be careful, because if you skip the first step, you're going to get the wrong answer. Step 1, bring depreciation up to date. If we sell an asset partway through the year, we first record depreciation for the months that we owned it this year, all the way up to the point of disposition. So that accumulated depreciation, and therefore book value, is current as of the sale date. Step 2, compare the proceeds to that updated book value. Exactly how much did you sell it for? Proceeds greater than book value is recorded as a gain. Proceeds less than book value is recorded as a loss. Let's look at an example. We own equipment that costs $50,000 with $35,000 of accumulated depreciation. So its book value is $15,000. And that just means the cost we have yet to allocate. We then sell it for $18,000 cash. And the journal entry has to do 3 things: get the asset off our books and get the cash on. We debit cash for $18,000 and we debit accumulated depreciation for $35,000 to remove it. Then we can credit the equipment account for its full original cost of $50,000, and those don't balance by themselves. So the plug is our gain. $18,000 received versus $15,000 of book value gives us a $3,000 gain, which we can credit to gain on sale. If we'd sold it for $12,000 instead, we'd be below book value and we'd debit a loss for $3,000 instead. Let's look at T accounts to clarify this example. And we'll just call this a generic asset account and fill it in with the numbers we've been given for accumulated depreciation as well. It's important to think of these 2 accounts, the asset account and the accumulated depreciation account, as married. This asset account has our $50,000 asset in it, and when it gets depreciated, it's simply allocating that $50,000 to expense or retained earnings over here. Remember, retained earnings consists of all of our expense accounts during the year. Temporary expense accounts during the year represent debits to retained earnings, and temporary revenue or sales accounts represent increases or credits to retained earnings. So the accumulated depreciation of $35,000 is kept separately in this accumulated depreciation account, a contra asset to this asset account, and it simply represents the credit side of the asset account, and that $35,000 credit also is a $35,000 debit to retained earnings. And that'll be put into expense accounts during the year, a little bit of it at a time, but in total, $35,000 has decreased retained earnings. So again, these accounts are married, the asset and accumulated depreciation accounts. So when this asset is sold, all we need to do is wipe out the asset account and wipe out the accumulated depreciation account because they'll no longer exist. So that requires a credit of $50,000 and a debit of $35,000. We are essentially wiping out the book value of this asset, which is $15,000, with those 2 journal entries, a debit to accumulated depreciation and a credit to the asset. We also have cash proceeds from this sale, and we are debiting cash for $18,000. So that is what is going to leave the requirement to recognize an increase in retained earnings of $3,000 because our proceeds here of 18 are greater than our book value of 15 by 3,000. So that is a gain in retained earnings, an increase of $3,000. So just to refresh your memory on the journal entry, we're debiting cash for $18,000. We are debiting accumulated depreciation for $35,000, crediting the asset for $50,000. And to balance this journal entry, the comparison of the cash proceeds to the book value give us a gain of $3,000. Now here's the conceptual point I really want you to understand. Students tend to instinctively feel that a gain is good and a loss is bad. But if you stop and think about what a gain on sale actually tells you, it simply means that we depreciated the asset or allocated cost faster than it lost real value. Our book value ended up lower than what the asset was actually worth. A loss often just means the reverse. Under the conceptual framework, a gain is simply an increase in net assets from a peripheral transaction, and a loss is a decrease. They're not verdicts on management's decision making. And note, we're talking financial accounting here, not taxes. A gain you'd happily report to shareholders. It's actually taxable. We'll talk about taxes more later, but for now, a gain or loss on disposal is just the correction for the fact that the book value and market value were never the same thing. So to summarize, when we dispose of an asset, first update depreciation to the date of sale, then compare proceeds to book value. The journal entry removes both the asset's cost and its accumulated depreciation, records what we received, and recognizes the difference as a gain or a loss. Gains and losses arise precisely because depreciation allocates cost rather than tracks fair value. So book value rarely matches selling price. And a gain isn't a gold star, nor is a loss a failure. They're just the truing up between book value and reality. Next, we'll take this whole framework and apply it to natural resources where allocation gets a new name: depletion.